$147,000. You are staring at that number on a PDF that has your name at the top and the bank's logo at the bottom. The offer letter is 3 pages. You have read it 6 times. You are 22 years old and you are sitting on the edge of a twin bed in an apartment you share with 2 other people. And the only light in the room is the glow of your laptop screen. It is 11:47 p.m. You have a flight at 6 a.m. You haven't packed. You hit accept. The confirmation email arrives in 4 seconds. Something has already started. You are 22. $85,000. That is your base salary. Your signing bonus is $10,000. Your year-end bonus, if you hit your targets, will be somewhere between $40,000 and $70,000. On paper, your first-year total compensation is $147,000. After federal tax, state tax, New York City tax, and the $2,400 a month apartment you share with one other analyst from your incoming class, you will take home approximately $5,900 a month. You do the math on your phone during the subway ride to orientation. You put your phone back in your pocket and don't look at it again. The office is on the 43rd floor of a glass tower in Midtown Manhattan. You badge in at 8:47 a.m. on your first day. A woman at the security desk hands you a lanyard. The lanyard has your photo on it. You look younger in the photo than you thought you did. You walk to the elevator bank. The elevator smells like carpet cleaner and someone else's cologne. Your desk is a 24-inch monitor, a docking station, a keyboard, and a chair that squeaks when you lean back. You stop leaning back after the first week. The analyst bullpen has 43 desks arranged in a grid. Every desk looks the same. Every desk has a coffee cup somewhere on it. The work is this. You build financial models in Excel. You create pitch decks in PowerPoint. You run comparable company analysis. You format tables for 8 hours and then an associate sends them back with the comment font should be Calibri 9, not 10, and you reformat them. You send them back. 40 minutes later, orders are off. You fix the borders. You send them back. This is not metaphor. This is Tuesday. Your hours in the first 3 months averaged 97 per week. You track them in a notes app because no one told you to and no one told you not to. Week 4 is 112 hours. You stop tracking after week 11. Not because the hours drop, because the numbers stopped meaning anything. The thing no one tells you about a 100-hour week is that time stops feeling linear. Monday and Saturday become the same. You lose the sensation of a weekend. You develop a new relationship with 3 a.m., not hostile, not friendly. Just familiar. There is a diner 3 blocks from the office. You know the overnight menu by cardiac region. The things that keep you going and the things that over time quietly don't. The associate above you is named Marcus. He is 28. He sends you comments on your models at 2 a.m. and expects responses before he wakes up at 7. You learn to sleep in segments. You learn to shower in 4 minutes. You learn that the right answer to every question in this building is, "I'm on it," and then you go be on it. You make one mistake in month 3. A row in a cash flow model references the wrong cell. The error propagates across 4 slides in a client deck. The managing director catches it at 5 p.m. on a Thursday before a 7 p.m. client presentation. He does not raise his voice. He says 2 words, "Fix it." You fix it in 40 minutes. A senior analyst named Jordan, 2 seats down from you, stays until it is done without being asked. You notice that. You don't say anything. You send a revised deck. The MD sends back a single period. Jordan is 24. She has been here 2 years. She has a water bottle on her desk covered in stickers from cities she has not had time to visit. She explains the Excel shortcut for auditing formula dependencies at 1 a.m. on a Wednesday in a way that takes her less than 60 seconds. You use that shortcut every day for the next 4 years. The work is not the point, she says one night, standing by the printer while your models compile. Surviving the work is the point. She switches to a hedge fund 6 weeks later. You never see her again. What kills analysts here? Disappearing. Not failing a model. Not getting a number wrong. Disappearing, becoming invisible. Becoming the person whose name the VP forgets when they are assigning the next live deal. The analysts who wash out in year 1 are not incompetent. They are quiet in the wrong rooms. They send emails when they should walk to desks. They fix errors and don't make sure anyone saw them fix them. What promotes you? You are correct, fast, and present every time someone with power looks up. Not twice. Every time. Level 2. Associate. You are 26. $175,000. That is your base. Your bonus target is 100% of base. Your total first-year associate compensation will land at $290,000 if you are rated strong. You paid $212,000 for your MBA. Tuition, housing, 2 years of foregone income compressed into a number that your new salary will begin retiring at roughly $14,000 per year net, after interest, after tax, after the fact that you now have an apartment by yourself for the first time since college, and it costs $4,100 a month. You did 2 years of analyst and then you left. Then you did 2 years of business school. Then you came back. You are now the same age Jordan was when she told you the work was not the point. You think about that sometimes when you are the one sending 2 AM comments on a junior analyst's model. Your title is associate. Your business card says associate. The associates at this bank sit 2 rows behind the analysts and 1 row in front of the VPs. The geography is not accidental. Your job is to manage the analysts and translate for the VPs. You check the analysts' models for errors before the VP sees them. You sit in client meetings and you do not speak unless spoken to. And you are spoken to less than you expected. You present slides you built to clients who look at the VP when they ask their follow-up questions. You write the follow-up email. The VP's name is on the follow-up email. A live deal comes in during your 4th month. A mid-market industrial company in the Midwest is selling itself. The deal size is $620 million. You will build every model. You will run every scenario. You will be on every internal call and on no client calls until month 2 of the deal, when your VP, a man named David, takes you to a site visit at the company's manufacturing facility in Cincinnati, Ohio. The facility smells like machine oil and floor wax. A gray-haired man in a hard hat shakes David's hand and nods at you. David introduces you. The man in the hard hat looks at you for 3 seconds, and then looks back at David. David says your name again. The man in the hard hat nods again and starts walking. In the conference room afterward, you present 3 pages of the deck you built. David presents the rest. On the plane back, David leans over the seat divider and says 7 words. The MBA bought you a seat, not a voice. You look out the window. Below you is Ohio. The plane banks left. What kills associates? The gap between expectation and reality. You spent $212,000 in 2 years and you came back expecting to be treated differently than you were as an analyst. The hours are slightly fewer, 75 to 85 per week instead of 97, but the emotional labor is greater. You now manage people who remind you of yourself 3 years ago, and you are responsible for their errors. And you feel the weight of that every time a VP sends a comment back down. The associates who don't make it to VP either leave voluntarily, private equity, corporate development, a startup, or they are managed out quietly in year 2 with a conversation that starts with the phrase cultural fit. Both exits look identical from the outside. What promotes you? You stop waiting to be handed authority and you start behaving as if you have it. One decision at a time. One meeting at a time. Until people stop questioning whether the decision was yours to make. Lesson. The credential opens the door. What you do in the first 5 seconds of the room determines if you are invited back. Level 3. Vice President. You are 30. $250,000. Base salary. Your bonus this year, in a decent market, will be $200,000 to $350,000. Your total compensation is real money now. Money that feels different from the $147,000 on the offer letter you accepted at 22. You buy furniture. You contribute the maximum to your 400 and own it. You start thinking about what a down payment looks like. Then you open your calendar and the thought goes somewhere quiet. Your title is Vice President. In the outside world, Vice President sounds like a person who has authority. In this building, the EP is the rank where you become responsible for everything that happens below you and receive credit for nothing that goes right above you. You manage 4 analysts and 2 associates. You review every model before it goes up. You run internal deal teams. You are the connective tissue between the junior bankers who build the work and the directors and MDs who sell it. You attend every meeting. You run half the meetings. Your name is on the tombstone when the deal closes, but it appears below the director's name and the MD's name in a font size that is noticeably smaller. A deal closes in your second year as VP. $1.4 billion acquisition. 12 months of work. You were the one who found the buyer. You structured the preliminary term sheet. You coordinated 47 calls between legal, the client, and the acquirer over 8 months. On the night the deal closes, there is a dinner at a steakhouse on 54th Street. The client shakes the MD's hand, then the director's hand. They give you a nod across the table and say, "Great work." You say 2 words, "Thank you." You mean it and you don't mean it simultaneously. You manage a second-year associate named Priya. She is 28. She reminds you of you. Not in personality, in tempo. She works the way you worked at 26. Thorough, silent, better than she needs to be for the audience she currently has. You give her the lead model on a $900 million REIT deal in month 4 of her time on your team. She runs it without an error. You tell David, now a director, at a year-end review. He nods and writes something down. You do not know if he writes her name or something else. You do not ask. A director passes your desk on a Thursday in October. He is carrying a coffee and a printout. He does not stop walking. He says 5 words over his shoulder. Managing people is more work. He disappears around the corner. You sit with that sentence for 6 months. What kills VPS? The management trap. You are good enough at banking to keep moving. You are now also responsible for teaching, correcting, and absorbing the failures of 4 to 6 people below you while executing on your own deliverables. The hours don't change, 70 to 80 per week. But the texture of the hours changes. Before, the pressure was external. Someone told you it was wrong and you fixed it. Now you are the one who has to catch it before it goes up, which means the pressure lives inside the work rather than arriving after it. The VPs who don't make it to director are the ones who pick a side. They either go deep into the work, become the best technical banker in the group, and never build the relationship capital that directors need, or they go too far into management and their models start coming back with errors they should have caught. The ones who survive learn to hold both at the same time without letting either drop. What promotes you? You bring in revenue. Not in a vague way, in a specific way. You get a client on the phone. You identify a deal. You show the MD that the bank makes money when you are in the room. Lesson, the title says vice president. The job says middle management. The exit is selling. Level 4. Director. You are 35. $400,000 base. Your bonus this year will be somewhere between $400,000 and $800,000 depending on what closed, what you originated, and what mood the market was in when the MD made the recommendations. Your total compensation could be $1.2 million. It could also be $700,000. The range is wide. You do not control it. You stopped pretending you did in year 2. Your title is director. In some banks, this rank is called senior vice president. The name changes. The function doesn't. You are the bridge between the VPs who execute and the MDs who own the client relationships. You pitch. You travel. You cover a sector. Let's say industrial technology. And you know every CFO in that sector who takes your calls. And you know the ones who don't. And you spend a not small portion of your life trying to move the second group into the first. You have a client. His name is Robert. He is the CFO of a $3 billion manufacturing company in the Southeast. You'd have had dinner with Robert 11 times over 4 years. You flew to Atlanta for his company's Analyst Day when no deal was live. You sent him a book that you read and thought he'd find useful. He has your cell number. You have his. When he calls, you pick up on the first ring. Then the MD, a woman named Catherine, calls you into her office. She is calm. She is always calm. She says 9 words. We're moving Robert's coverage to Patterson's team. Patterson is an MD who joined from a competing bank 8 months ago. He also knows Robert. He has known Robert for 12 years from before you were at this bank, from before you were at the previous bank, from before your MBA. You sit across from Catherine and your face does not change. A burned-out director named Elliot finds you later that afternoon. He is 41. He looks 50. He sits in the chair across from your desk and says 11 words slowly. The client relationship is never yours. It belongs to the bank. He transfers to a regional office in Charlotte 3 weeks later. You hear secondhand that he is coaching his son's baseball team now and sleeping 8 hours a night. You think about that for longer than you intend to. What kills directors? The invisible ceiling. You can see the managing director level from here. It is one rung above you. You can see exactly who is there, exactly what they do, and exactly how many of them there will ever be. Your bank has 43 MDs globally in your product group. There are 6 open director seats below the MD line. The directors who will be promoted next year are already identifiable by the size of their deal tombstones and the length of their client rosters. If your roster doesn't grow, you don't move. The ceiling is not made of glass. It is made of client names, and you either have enough of them or you don't. What promotes you? A client relationship that you built, that is yours by tenure and trust, that the bank cannot easily transfer to someone else. One relationship like that. Just one. Lesson: at this level, you are not a banker. You are a book of business. The question is whether the book is big enough. Level 5. Managing Director. You are $600,000 base. Your bonus last year was $2.1 million. The year before, $1.4 million. The year before that, $3.3 million. A good year, a large deal, a market that cooperated. You have been an MD for 3 years. You own a home. Your children are 7 and 4. You see them on Sunday mornings and for approximately 40 minutes on weekday evenings if the markets cooperated, and if no client had a crisis, and if no junior banker on your team sent something up that came back wrong from the committee and had to be rebuilt overnight. You think about the cold open sometimes. Not often. But sometimes. There is a young analyst on your team. She is 22. She has a water bottle on her desk covered in stickers from cities she has not had time to visit. You do not tell her what you know about that water bottle. You do not tell her that in 18 years she may be sitting in a chair identical to yours, in a building almost identical to this one, looking at a calendar that has no white space left in it, trying to remember the last time she chose what to do with a Wednesday. You remember Jordan, the one who told you, at 1 a.m. in front of a printer in 2009, that surviving the work was the point. You looked her up once on LinkedIn. She runs a 40-person hedge fund in Greenwich. She has a dog and a sailing certification and posts twice a year. Her last post was a photo of a mountain she climbed in Patagonia. She posted it on a Tuesday. You remember the diner, the one 3 blocks from the office. You haven't been there in years. You get breakfast sent up now. You remember the MBA, $212,000. You paid it off in year 2 as a VP. The degree hangs in a frame in your office. You look at it roughly once per quarter, when you are standing at the window waiting for a call to connect, and you cannot remember the last time it mattered. You are now the mentor. You are the MD in someone else's story. Some morning you will say something in a hallway and walk away, and that person will carry it for a decade, and you will not remember saying it. A managing director named Carl is retiring this month, 31 years in this industry. He is 63. He has an apartment in the city and a house in Connecticut, and a $40 million net worth and a handshake that he has refined over 3 decades into something that feels like trust. He calls you into his office on his last day. He sits on the edge of his desk. He says 17 words. The ones who make it here either love the game or forgot they had a choice. He shakes your hand. You walk back to your desk. You have 2 calls in 4 minutes. A client in London. A board presentation for a deal you originated in March. You open your laptop. The screen brightness is set to maximum because the office lights are off. You have not left this desk in 6 hours, and the afternoon went somewhere without you. You look at your phone. Your child called at 3:47 p.m. You were on a call. There is a voicemail. You will listen to it after the London call. You have been saying "after the next call" since 2008, and you have not yet found the end of the calls. The offer letter is somewhere in a filing cabinet at your apartment. 3 pages. Your name at the top. The bank's logo at the bottom. You were 22. You were sitting on the edge of a twin bed. The number was $147,000, and it felt enormous. The number is different now. The bed is the same size. You pick up the phone. The ladder does not end at the top. It just gets narrower.